Most of the time when people talk about the origins of the free market, they jump straight to Adam Smith. Sometimes they add Ricardo, occasionally Marx, if the conversation turns political, but almost no one looks further back, past the Enlightenment, past Europe, into a world that was already wrestling with markets, money, and power centuries earlier. That omission matters more than we think, because long before stock exchanges, central banks, or GDP charts existed, one man was quietly studying why economies rise, why they decay, and why prosperity never collapses all at once, but rots slowly from the inside. And what he saw would unsettle modern economists. Ibn Khaldun wasn't trying to invent capitalism, he wasn't defending merchants or attacking kings, he was trying to understand something far more dangerous: the hidden forces that turn productive societies into extractive ones, short line, that shift changes everything. To understand why his ideas feel so modern, you have to drop the comforting illusion that free markets were discovered in the 18th century. Markets existed wherever people traded, trusted, cooperated, and feared losing what they had built. Ibn Khaldun lived in a world of caravans, ports, dynasties, taxes, labor, and collapse. He watched cities grow rich, then hollow. He saw rulers squeeze economies dry, then wonder why trade vanished. And he noticed a pattern that repeated itself with unsettling precision. But here's the part most people miss. Ibn Khaldun didn't study prices first. He studied people. He believed markets were not mechanical systems governed by numbers alone, but living social organisms shaped by trust, power, incentives, and collective behavior. When those forces aligned, wealth flowed naturally. When they broke, no law or decree could save the economy. That insight sounds obvious now. It wasn't then. And it leads to a question that feels uncomfortably current. What happens when economic growth outruns social cohesion? When wealth concentrates faster than trust can sustain it? When rulers and elites extract more than they contribute? Ibn Khaldun had an answer, and once you see it, you can't unsee it. Because his free market insight didn't begin with trade theory, it began with something far more fragile, something every economy depends on but almost never measures. To understand why Ibn Khaldun saw markets so clearly, you have to understand how unstable his world really was. He wasn't writing from the safety of a university tower. He lived through exile, court politics, collapsing dynasties, and sudden reversals of fortune. 1 year advising rulers, the next fleeing them. 1 year inside power, the next watching it fall apart from the outside. That perspective changes how you see everything. Born in the 14th century in North Africa, Ibn Khaldun grew up in a world where states rose fast and died faster. Cities flourished on trade, then emptied under taxes. Dynasties promised order, then consumed themselves through greed and fear. He didn't just read about decline, he survived it. And somewhere between serving governments and escaping them, he noticed something few rulers ever admit. The economy doesn't collapse first, the social fabric does. That realization became the foundation of his greatest work, the Muqaddimah. On the surface, it looks like history. In reality, it's a forensic report on how societies function and fail. Ibn Khaldun treated civilizations the way a physician treats a body. Symptoms first, causes beneath, consequences inevitable. He wasn't interested in ideal systems. He was interested in real behavior, how people act when power concentrates, how merchants behave when trust erodes, how rulers respond when revenue dries up. And here's the critical turn. Instead of asking how to maximize wealth, Ibn Khaldun asked why wealth stops working, why productive economies turn extractive, why labor loses dignity, why taxes rise even as revenues fall, why states respond to decline by accelerating it. Most economists start with incentives. He started with cohesion. He believed every functioning society rests on a shared sense of obligation, a collective willingness to contribute before extracting. When that bond is strong, markets thrive almost effortlessly. When it weakens, every transaction becomes a struggle, every policy a patch, every reform temporary. But Ibn Khaldun didn't romanticize unity. He warned that cohesion decays naturally over time, especially as wealth grows. Comfort dulls responsibility. Elites detach. Institutions harden. And when that happens, markets don't just malfunction, they turn predatory. That's the lens through which he saw trade, taxation, labor, and money. Not as isolated systems, but as expressions of social health. Once you accept that, free markets stop looking like abstract ideals and start looking fragile. And that leads directly to the concept that sits at the center of his entire theory. Ibn Khaldun gave that invisible force a name, asabiya. At first glance, the word feels distant, tribal, ancient, irrelevant to modern finance. But strip away the language, and what he was describing is something every market still depends on. Social cohesion, shared obligation, mutual trust, short line, the glue. For Ibn Khaldun, asabiya was the collective bond that made cooperation possible before contracts, courts, or enforcement ever stepped in. It was the reason people honored deals, paid workers, defended institutions, and restrained greed even when cheating was easier. And when that bond was strong, something remarkable happened. Markets worked. Trade expanded without force. Labor became productive instead of resentful. Wealth circulated instead of freezing in place. Transaction costs, though he never used the term, collapsed naturally because people trusted one another enough to exchange without constant fear. But here's where his thinking gets sharper. Asabiya wasn't just a moral ideal. It was an economic engine. Societies with strong cohesion could mobilize labor faster, collect taxes more efficiently, defend trade routes more effectively, and absorb shocks without tearing themselves apart. Prosperity followed not because people were virtuous, but because coordination was cheap. That's the part modern economics often forgets. Trust isn't a bonus, it's infrastructure. But Ibn Khaldun also saw the darker arc. As wealth accumulates, cohesion weakens. Elites grow distant. Comfort replaces contribution. The shared sense of obligation erodes, replaced by entitlement at the top and resentment below. Asabiya thins quietly, gradually, until markets still function, but only on the surface. This is the dangerous phase. Transactions continue, but trust is gone. Contracts multiply, enforcement expands, cheating becomes rational, rent-seeking replaces production. People stop asking, how do we grow together? And start asking, how much can I extract? And once that shift happens, decline is already underway. Not because trade disappears, but because cooperation does. Ibn Khaldun believed this was the fatal transition every civilization faces. The moment markets stop being social systems and become battlegrounds. From the outside, wealth still exists. Inside, the engine is cracking. And that raises a brutal question. If cohesion creates prosperity, what happens when wealth itself begins to destroy it? Ibn Khaldun believed there was a moment when wealth stopped nourishing society and started suffocating it. You could see it in cities where treasuries were full, yet markets felt starved, where elites grew richer, yet labor grew poorer, where money existed everywhere except where it was needed most. That contradiction wasn't accidental, it was structural. To Ibn Khaldun, wealth only mattered when it moved. The moment money stopped circulating, it stopped doing its job. Hoarded wealth didn't strengthen a society, it quietly weakened it. Because money locked away in chests, vaults, or estates doesn't pay workers, doesn't fund trade, doesn't create demand. Short line, it just sits. And when money sits, economies slow. He understood something deceptively simple. Circulation is life. When wealth flows through wages, trade, and production, it keeps people working, markets active, and trust intact. But when it pools at the top, the bloodstream of the economy begins to clot. This wasn't moral outrage, it was diagnosis. Hoarding creates artificial scarcity, not because resources vanish, but because access does. Prices distort, competition shrinks, small producers collapse. The poor feel the pressure first, then the middle, and eventually, even the wealthy discover that their riches exist inside a shrinking system. That's the trap. At first, concentration looks like success, efficiency, smart accumulation. But over time, the very act of extracting more than you return hollows out the market you depend on. Demand weakens, labor disengages, social resentment grows. And here's the reversal most people miss. Hoarding doesn't just hurt the poor, it destabilizes the entire structure. Ibn Khaldun warned that when wealth stops circulating, people stop believing the system is fair. And once that belief fades, behavior changes. Workers disengage. Merchants cut corners. Consumers lose trust. Cooperation gives way to suspicion. That's when markets become brittle. But hoarding is rarely the end of the story. It creates pressure, and pressure seeks release. When circulation fails, another force rushes in to compensate. Speculation, profit without contribution, gain without creation. And once speculation takes root, trust doesn't just erode, it collapses. Speculation enters a market quietly. It rarely announces itself as greed. It arrives disguised as intelligence, foresight, even sophistication. A rumor spreads, prices move, someone profits without producing anything at all. Short line. Others, noticed Ibn Khaldun, saw speculation not as cleverness, but as corrosion. To him, profit only had legitimacy when it emerged from contribution from labor, risk, or real exchange. Speculation broke that chain. It separated gain from value, reward from effort. At first, the damage looks minimal. A few traders exploit shortages, a handful of merchants manipulate information, prices spike, then settle. The system appears intact. But beneath the surface, something vital is changing. Trust is thinning. When people realize that prices no longer reflect reality, behavior shifts. Merchants stop believing one another. Buyers assume deception. Sellers hedge against loss by raising prices further. Every transaction becomes defensive. And here's the turning point. Once speculation becomes normal, honesty becomes irrational. Ibn Khaldun understood this feedback loop instinctively. When cheating pays, integrity becomes a liability. When manipulation is rewarded, contribution feels foolish. Markets don't collapse because people become immoral. They collapse because incentives teach people to stop being honest. That's the contagion. Speculative behavior spreads faster than production ever could. It requires no factories, no skills, no patience, just timing, leverage, and the willingness to profit from imbalance. And once it dominates, the economy begins feeding on itself. Short line, value disappears. This is where Ibn Khaldun's insight sharpens. He didn't believe speculation merely distorted prices. He believed it rewired society. It trained people to extract instead of build, to anticipate collapse instead of prevent it, to view others not as partners but as opportunities. And when enough people think that way, markets stop being cooperative systems. They become battlegrounds. But speculation doesn't thrive in a vacuum. It flourishes when institutions fail to restrain it, or worse, when power protects it. When rulers tolerate manipulation or profit from it themselves, the decay accelerates, which leads directly to Ibn Khaldun's most dangerous warning. When the state itself begins to cheat, trust doesn't erode slowly, it vanishes. Ibn Khaldun was unambiguous about one thing. When rulers manipulate money, they are stealing, not dramatically, not all at once, but slowly, and from everyone. In his time, this theft took a familiar form. Coins were diluted, gold mixed with base metals, silver content quietly reduced. On paper, nothing changed. The currency looked the same. The state paid its debts. Budgets survived another year. Short line. The damage came later. Ibn Khaldun understood what many rulers refused to admit. Money only works when people trust it. The moment a state weakens its currency, it breaks an invisible contract with its citizens. Every transaction that follows carries doubt. Every price hides suspicion, and suspicion spreads fast. The poor suffer first. Their wages buy less, their savings erode. They have no assets to escape into. But the effect doesn't stop there. Merchants respond by raising prices, traders demand safer alternatives, foreign coins begin circulating quietly, then openly. That's the cascade. What rulers saw as clever fiscal management, Ibn Khaldun saw as systemic sabotage. Debasement didn't solve revenue problems, it created them. Trust evaporated. Trade slowed, tax collection fell. And to compensate, rulers intervened again. More taxes, more manipulation, more collapse. This is the trap he warned about. States under pressure don't reform, they extract. They squeeze the productive classes until production breaks, then blame merchants, workers, or foreign forces for the damage they caused themselves. And here's the deeper insight. When the state cheats, everyone feels justified cheating back. If rulers steal through currency, merchants steal through prices. If institutions lie, individuals rationalize dishonesty. Integrity stops being a standard and becomes a luxury. The entire system tilts toward exploitation. Short line from the top down, Ibn Khaldun believed rulers had a role in markets, but it was limited. Protect fairness, enforce contracts, preserve currency integrity. Once power crossed into manipulation, it became destructive, and when that boundary disappears, decline accelerates. Because the final collapse of an economy is never caused by scarcity. It's caused by disbelief. For Ibn Khaldun, labor wasn't just an economic input. It was the backbone of civilization. He believed societies grow strong when people see a clear link between effort and reward. When work is respected, contribution is visible, and dignity flows from producing something real. Labor, in his view, wasn't a burden to escape. It was how individuals anchored themselves to the collective. Short line. Work made society tangible. When people earned wealth through effort, Ibn Khaldun argued they developed discipline, patience, and responsibility. Skills accumulated, productivity rose. Markets expanded organically because people believed the system recognized their contribution. But when wealth detached from work, something broke. Unearned income extracted through privilege, manipulation, or proximity to power didn't just distort incentives. It corroded character. People stopped investing in skills. Innovation slowed. Social resentment grew. The economy still functioned, but its foundation weakened. This wasn't moral preaching. It was observation. Ibn Khaldun watched societies where labor lost status and rent-seeking flourished, where elites lived off taxes and monopolies, while workers carried the burden, where young people learned that proximity to power paid better than mastery of a craft. That lesson spreads fast. When effort stops mattering, people stop trying, productivity falls, informal economies expand, trust erodes between classes, and eventually, even the ruling elites discover that there's less real wealth left to extract. Short line, the system eats itself. He believed dignified labor was the quiet stabilizer of markets. It tied individuals to outcomes. It reinforced fairness. It kept resentment from turning into revolt. When labor was honored, societies endured hardship. When it was exploited, collapse followed. And here's the uncomfortable reversal. The more a state squeezes labor to fund excess at the top, the faster labor disengages. What looks like obedience is often withdrawal. What looks like stability is decay. Ibn Khaldun understood this centuries before productivity graphs existed. Economies don't weaken because people stop working. They weaken because people stop believing work is worth it. Ibn Khaldun did not believe strong economies required powerful rulers. He believed they required restrained ones. That distinction mattered. In his view, the role of the state was not to dominate markets, direct outcomes, or extract maximum revenue. It was to protect the conditions that allowed markets to function on their own: fairness, predictability, and trust. Short line, nothing more. He warned that when rulers tried to optimize the economy through excessive control, they usually achieved the opposite. Heavy taxes discouraged work. Arbitrary rules suffocated trade. Confiscations shattered confidence. Every intervention created distortions that demanded another intervention to fix, and so the cycle began. Ibn Khaldun observed that states often mistook activity for prosperity. As long as money moved into the treasury, rulers believed the economy was healthy. But beneath the surface, production weakened. Merchants withdrew, labor disengaged. What looked like growth was often just extraction, accelerating before collapse. This led to one of his clearest principles. Low, predictable taxation grows revenue. High, arbitrary taxation destroys it. When people know what to expect, they plan, invest, and expand. When rules change without warning, survival replaces ambition. Markets don't need perfect laws, they need stable ones, but restraint extended beyond taxes. Ibn Khaldun argued that rulers must resist monopolies, favoritism, and rent granting. When power decides who profits, markets cease to reward skill or effort. They reward proximity, and once that happens, productive people exit physically or mentally. Short line, capital flees first. The strongest states, in his view, were those that interfered the least. Not because rulers were weak, but because institutions were trusted. Courts were predictable. Currency was honest. Contracts were enforced without favoritism. This wasn't ideology. It was survival logic. States that protected markets prospered quietly. States that exploited them burned brightly and briefly, and history followed the script. Ibn Khaldun didn't need modern data to test his ideas. History did it for him. Again and again, the same pattern appeared. States expanded, wealth concentrated, taxes rose, currency weakened, trust faded, trade slowed, collapse followed, not suddenly but predictably, short line, always in that order. Centuries later, the details changed, but the mechanics didn't. Weimar Germany printed money to survive political chaos and destroyed its currency. Zimbabwe monetized deficits and watched markets abandon local money. Venezuela debased trust alongside its coinage and saw capital, labor, and confidence flee together. Different eras, same script. In each case, rulers believed they could bend economic reality without consequences, that they could extract more without weakening production, that confidence would somehow survive deception. Ibn Khaldun warned this never works. Once people stop believing the system is fair, they stop playing by its rules. Savers rush to escape weakening currencies. Merchants price in fear. Workers demand more just to stand still. Informal markets expand. Institutions hollow out. What looks like inflation is often something deeper, a collapse of belief. Ibn Khaldun understood that money is not just metal or paper, it's a promise, a shared agreement that effort today will be rewarded tomorrow. When that promise breaks, no policy can force people to trust again. Short line. Trust cannot be printed. This is why nations with stable institutions thrive even without vast resources. Transparent courts, predictable regulation, and honest currency do more for prosperity than any stimulus program ever could. Markets don't grow because states command them to. They grow because people feel safe enough to contribute. And when that safety disappears, even the wealthiest societies become fragile. Capital flees, talent disengages. Cooperation collapses into survival, which brings us uncomfortably close to the present, because the conditions Ibn Khaldun described are no longer historical curiosities. They're headlines: debt expansion, asset bubbles, institutional distrust, rising inequality. The question isn't whether his theory still applies. It's whether we're willing to recognize the signs before the cycle completes. Ibn Khaldun didn't just describe collapse. He left warnings, and they weren't abstract. They were practical signals, ways to recognize when an economy is drifting from productive growth toward quiet decay. The first signal is simple. Watch where wealth moves. When money circulates through wages, trade, and investment, markets strengthen. When it pulls upward and stops returning to production, fragility sets in. Concentration doesn't announce collapse, it prepares it. Short line, stagnation comes next. The second signal is incentive drift. When systems reward extraction more than contribution, behavior follows. People stop building and start positioning. Skills matter less than access. Risk-taking shifts from innovation to exploitation. Growth continues, but hollow. Ibn Khaldun believed this phase was the most dangerous because it still feels like prosperity. The third signal is institutional erosion. When courts lose credibility, contracts feel optional. When rules change without warning, planning becomes pointless. When currency weakens, trust flees first, long before capital does. None of this requires corruption in every corner. Just enough, short line, enough is sufficient. And here's the most uncomfortable lesson. You cannot repair an economy by commanding confidence. You rebuild it by aligning incentives, so honesty becomes rational again. Predictable laws, honest money, moderate taxation, respect for labor. These aren't ideological preferences. They're survival conditions. Ibn Khaldun understood that markets don't need perfection. They need credibility. People will tolerate hardship. They will adapt to scarcity. What they will not tolerate for long is deception. This is where his insight becomes personal. Every economy survives on millions of quiet decisions to work, to save, to invest, to cooperate. When people believe the system rewards effort fairly, those decisions compound into growth. When belief fades, the same decisions compound into withdrawal. Short line, collapse, is collective. And that brings us to the final truth Ibn Khaldun left behind. Economic systems don't fail because equations stop working. They fail because people stop believing the rules apply equally. Ibn Khaldun's final insight was also his most unsettling one. Civilizations don't collapse when they run out of money. They collapse when trust runs out first. He believed prosperity rests on something far more fragile than resources or technology. A shared belief that effort matters, rules apply, and contribution is rewarded more than manipulation. When that belief holds, societies absorb shocks. When it breaks, even wealth becomes powerless. Short line, because money follows trust. This is why Ibn Khaldun still feels uncomfortably modern. He wasn't predicting financial crashes. He was diagnosing moral exhaustion. He saw that when elites extract without restraint, when rulers bend rules for survival, when markets reward positioning over production, people don't revolt immediately. They disengage, workers withdraw effort, merchants hedge instead of invest. Citizens stop planning long-term. The system keeps moving, but only out of habit. And once belief fully dissolves, collapse looks sudden, even though it was years in the making. That's the illusion history keeps repeating. We like to think economic failure is technical, a policy mistake, a miscalculation. Ibn Khaldun rejected that comfort. He argued collapse is behavioral, emotional, collective. It happens when fear replaces trust, when greed replaces responsibility, when short-term survival replaces shared purpose. Short line. By then, it's late. What makes his work endure isn't that he anticipated free markets. It's that he understood their limits. Markets don't exist independently of society. They are expressions of it. Strengthen the social fabric, and markets flourish. Let it fray, and no system can compensate. This is not medieval philosophy. It's a warning that prosperity without responsibility is temporary, that wealth without circulation is brittle, that power without restraint corrodes the very foundation it depends on. Ibn Khaldun wasn't asking people to be moral for morality's sake. He was explaining how civilizations survive. And if that feels relevant today, it's because the conditions he described are not rare, they're cyclical, which means understanding them isn't academic, it's protective. History doesn't repeat, but ignorance always does. If you want to understand where economies are heading, look beyond numbers, look at trust, look at incentives, look at whether contribution still matters, because once it doesn't, the outcome is already written.